The first Federal Reserve meeting of the year takes place Tuesday and Wednesday. Now, we won't get an interest rate cut this time around. Inflation remains stubbornly high, and that's pushed the Fed to the sidelines. Inflation is still around the 3% mark, and we've seen very little in the way of progress toward the goal of 2% in more than a year. If interest rates are going to come down, inflation has to come down. And right now, it's not. So the message to borrowers: you've got to stay on offense about paying down that high cost debt. The Fed is not going to be in a hurry to cut interest rates. So credit cards, the average credit card rate's over 20%. You can take advantage of those 0% and other low rate balance transfer offers to get you to the finish line. If you have home equity debt, a lot of home equity lines are still carrying rates over 10%. Have a game plan for paying that back. This is no longer the low cost debt that it was for the better part of 2 decades. Now, on the bright side, for savers, you're going to continue to enjoy returns that exceed the rate of inflation, but only if you have your money in the right place. Think high yield savings accounts and the top yielding CD offers that you find on Bankrate. Mortgage rates still in the 7% neighborhood. That's hurting both affordability and home sales. For prospective home buyers, keep your eye on inflation, more so than the Fed. It's going to take a decline in inflation in order to get mortgage rates down. The Federal Reserve cutting interest rates, that by itself won't do the trick.